How's it going, everyone? Today we're looking at Texas Instruments stock. The stock is down 7.3% after hours trading. We're going to take a look at the reasons why that is, as well as the valuation of this company to try to understand, is it a buy right now? And first things first, we'll look at the results of these earnings, compare them to the analyst ratings. So it says here, Texas Instruments forecasted third quarter revenue above Wall Street estimates on Tuesday, signaling recovering demand for its analog chips, even as U.S. tariff negotiations lead to a macroeconomic uncertainty. The company expects revenue in the range of $4.45 billion to $4.8 billion for the third quarter, compared with analysts' average estimate of $4.59 billion, according to data compiled by LSEG. So you did get revenue expectations above the analyst estimates. However, the issue is in some downgrades in the overall profitability. It says here, however, its forecast for September quarter profit was just shy of estimates. The company expects earnings between $1.36 per share to $1.6 per share, the midpoint of which is below estimates of profit of $1.49 per share. So shares of the company fell 8% extended trading, which we just saw. So that's kind of the issue we're facing here, is that the guidance was a little bit below those expectations. And if we see the growth here, the growth has been pretty solid. Revenue grew year over year. We're comparing 3 months ended June 30th. $3.8 billion in 2024 compared to $4.44 billion revenue in 2025, which is pretty solid revenue growth. Net income also improved from $1.12 billion to $1.29 billion in overall net income. Diluted earnings per share also improved from $1.22 to $1.41. So year-over-year growth has been very solid for this company. Cash and cash equivalents on the balance sheet also increased from $2.7 billion in cash to $3 billion in cash on hand. So that is pretty solid as well. However, long-term debt did increase some, about $1.2 billion in additional long-term debt. The overall balance sheet does look pretty healthy with this company, and the growth as well has been solid. But the main issue why you're seeing the stock trading lower in after hours trading is it trades at a PE of 40.6 and a forward PE of 38.7. So with that higher multiple in mind, investors are going to have to see solid growth in the future for this company to justify that high PE. And that's why you're seeing such a harsh reaction on this stock in after hours trading, is because you need almost perfect growth and increasing guidance over time to justify this very high PE for this stock. Price to sales is also 12.2. So overall, the overall valuation of this company is very expensive. And you can see that that is justifying this hold rating, which you're getting from Seeking Alpha, as well as a Wall Street analyst. Factor grades, you're getting a valuation rating of D, growth D+, profitability A. So, I mean, the company is very profitable. You do get a solid dividend with this stock, but the main issue is it needs to grow at a fast pace to justify this high PE multiple. The analyst ratings, 43 analyst ratings, 37% buy, 53% hold, 9% sell, with a median price forecast of $200 per share, which is actually 7% below our current price. This is not updated though. After hours, we are at $198 per share now, and it's dropped now 7.6% at the time recording this video. So as you can see, the analysts are probably pretty right on this, especially with that high PE in mind. That's kind of the main issue you're facing here. Also, this stock has underperformed the S&P over the past 5 years. It's only gone up 61.5%. And it does pay a dividend, though. It pays a 2.54% dividend yield. But as you can see, this company has had a lot of fantastic growth in its past, but we're not seeing that in the current state. And if I were considering buying this stock, the main concern I'd have would be about this PE. It's an extremely expensive stock for the growth that you're getting. And I'd be very cautious buying such a modestly growing company at this very high valuation. You know, this is the type of PE you could justify for a company like Nvidia that's growing at a very fast rate, but this is difficult to justify for this stock. So I would be hesitant to buy it. I think that the hold rating is very justified. However, you want to hold this company and own it, by all means do so. Nice dividend yield there, and it has had fantastic growth in the past. This wouldn't be a bad stock to hold in a portfolio, but don't expect massive returns off it in the near term, is what most investors are reacting to with this earnings report. If this provided value to you, I hope it did. I provide videos like these on all different companies that are reporting earnings. So if you got value, consider subscribing, and y'all have a good one.